The hot new stock IPO is out, but is it going to be like Facebook, which has jumped fivefold since its IPO, or a total bust like so many others? In this video, I'm sharing the exact process I use to value IPO stocks for venture capital investors, including 2 valuation methods that will tell you how much a stock is worth. We're talking investing in IPOs today on Let's Talk Money.
Beat debt.
Make money.
Make your money work for you.
Creating the financial future you deserve.
Let's Talk Money.
Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the community. Thank you for taking a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. This is a video I wanted to do for a long time. I worked as a venture capital analyst for years, valuing private companies and pre-IPO stocks. I even created and managed a team of analysts for a Canadian VC firm. If you want to know how to make money investing, it's this kind of early stage investments that produce double and even triple digit returns. Now, I planned on doing this video around one of those big IPOs this year, but I didn't want it to be just about a specific company, about one specific stock. You know, those videos like, should you invest in the Uber IPO or this or that IPO, they're hugely popular, but you're pretty much stuck after that. Instead, I want to give you the tools you can use to value any stock IPO. I'm going to show you the exact process I went through to value a private company before its initial public offering. I'll reveal the valuation methods I used to show me exactly how much a stock would be worth and whether to buy it at the IPO price or wait till a later date. Trust me, you do not want to be wrong here. IPOs can provide spectacular returns, but many lose money from the start. Research by Renaissance Capital shows that almost half of all new IPOs trade lower by the end of the year, and 1 in 4 lose money on the first day. To show you exactly how to value IPOs, I'm going to be using the same process I used in a 2015 report to private investors for a funding round of Pinterest. I was hired to provide a valuation for investors in what turned out to be the social media giant's last big funding round before it went public at a $14 billion valuation. First of all, I want to talk a little bit about the IPO process, so how a company sells shares for the first time. I also want to point out a few of the reasons why I generally wait until after an IPO to buy a new stock and how you can use the analysis that I'll outline to find the right price to buy in at. So by the time a company files to issue stock in the public market, it might have been around for a decade or more as a private company. In fact, most companies are acquired rather than have an IPO. In my work as a venture capital analyst, I'd say maybe 1 out of 10 companies that we would look at would eventually IPO shares. For example, Facebook raised money for the first time in 2006, but would go through 14 funding rounds from private investors before its IPO in 2012. It raised just over $2.3 billion in private funding and was valued at $104 billion when it issued public shares. So that IPO made early investors filthy rich. You know, one of the first private investors, Peter Thiel, turned a $500,000 investment into a $1 billion payday. But that right there is one of the reasons you really need to know how to value a company at its IPO. By the time a company gets to this point, the private investors have sucked just about all the value they can get out of that investment. That's what they do, looking for companies that can grow cash flow to be sold off or issue shares. And as an analyst, that's what I helped them do. Now, another reason why I'm generally skeptical of buying in on a new IPO is what's called the lockup period. Understand that before a company issues stock, besides all these private capital investors, it's also sold shares to employees and large institutional investors. To keep these from dumping their shares at the IPO for that quick jackpot, companies have a lockup period of between 3 to 6 months that insiders and early investors can't sell their shares. The problem is when that lockup period expires, you get a lot of people looking to sell their stock. Now, obviously, not everyone is going to dump all their shares, but it can still be a big wave of the stock on the market for months, and just the simple supply and demand factors here. When you have a lot of supply, so lots of shares trying to be sold, but the demand stays the same, then the price just has to come down. We see a good example of the lockup period problem here with Alibaba. Its lockup period ended March 2015, and at this point, just the employees and insiders alone owned 437 million shares, or about 18% of the company. So you see here for about 4 months, the share price had a really tough time breaking higher because you had that big wave of sellers trying to unload some or all of their stock. So 2 reasons there you need to be extremely skeptical of buying new stock in an IPO. 2 reasons you absolutely need to do the analysis and then know that fair price for those shares. Now we're going to go to those valuation methods, that valuation method that I used for venture capital clients, but I want to get your opinion on something first. I want to start doing videos on different types of investments on the channel, but I want to know which of those are you most interested in seeing. For example, stocks, bonds, real estate, gold, and other metals investing, or maybe investing in currencies. So let me know in the comments below, what types of investments would you like to see covered on the channel? So let's walk through that valuation process that you can use for any new stock or IPO. This is the same process I used to value Pinterest in 2015 on its Series G funding, just 4 years before it issued shares. There are 4 parts to the process that I use to value any early stage and IPO companies. You first have your qualitative analysis, so you're looking at the industry and then competitive landscapes. You're looking at profits and positioning of similar companies already in the market and in the industry. Then you're going to look at the strategic focus of your IPO target. So management's focus, management's ability to deliver on any advantages. Now, I'll be making another video detailing this part of the process, how to really understand an industry and do that deep analysis. For the rest of this video, we'll focus on those valuation sides using the 2 methods that I'll share later. Next, you're going to dig into the company's financial statements and build out that cash flow model. This is where I would take management's forecast for growth, which were always overly optimistic, by the way, and then build out a realistic expectation for cash flows and income. I'll be doing this in another video as well because I want to get to those next 2 steps, the valuation methods that you can use to price a stock. These next 2 steps, the mergers and acquisitions valuation and then the comparables valuation, are where you really see how to start to how much this stock is actually worth. I'm going to show you exactly how to put these 2 together with public information to estimate a fair value on any IPO stock. Let's get to those 2 valuation measures that will show you how much a company and its stock is worth. But first, I need to ask a favor. If you like the video and you think that it's going to help you value an IPO, tap that thumbs up button below or let me know in the comments. So there's 2 methods that we'll look at here, the M&A or mergers and acquisitions method. Now this one looks at how much other companies are paying to acquire a similar company to the one you're valuing. In our Pinterest case, we'll be looking at acquisitions in the social media space to estimate how much the company is worth based on that sales and monthly users. The other one is done on competitor multiples, so looking at publicly traded companies to see how much they're trading for on that sales and active user basis. Let's look at that table here showing the M&A method for Pinterest, and I'll show you how to put this together in a minute, but I want to point out a few things first. Now this first column is just the date of the acquisition that was announced or completed. So the date the buying company, the acquirer, was saying that this target company was worth this much. Next we have the industry in which the target company operates. And this is important because, like we've talked about before on the channel, you have to compare stocks with similar companies in that same industry. For our Pinterest example, we'll look at other acquisitions for social media companies. The next few columns here are pretty self-explanatory. The target company and the acquirer, followed by the transaction value. Now this is the total price paid to buy the target company, and you want to make sure this includes all the value of cash, stock, and any debt. Finding acquisitions to compare in your IPO analysis is usually pretty easy. You can do a search on Google for the name of the industry and acquisitions, and then just look through the results for a list of past deals. These last 2 columns are the most important, and this is where you're going to get that company valuation. You want to get an idea of how much acquirers are paying for the sales and other financials of these target companies. Now, sales or revenue is a common measure, and sometimes you'll see earnings before interest, taxes, depreciation, and amortization, or EBITDA, in this second column. Here's where you need to know about the industry, though, and where some of that market analysis is going to come in handy. Here, since I know that monthly active users is one of the most important measures for a social media platform, I'm going to find the value on these deals according to how many users the platforms had at the time of the acquisition. So like I said, finding these deals is pretty easy usually with just a Google search on industry plus acquisitions. The part that you'll have to do a little bit more research on is finding the revenue and other measures at the time of the acquisition. For example, when I did a search for social media acquisitions, I found a couple of articles that listed out 6 of these deals, but none of them showed revenue and only a few showed the monthly active user statistics that I needed for those platforms. To fill out the table, I had to search Google for things like, the target company's name and revenue, or the target company's name and acquisition valuation. So this is going to take a little bit more time, but you can usually find the estimates for your table. Now, once we've got sales and active users for each target company, then you can take the transaction value, so that deal value, and divide it by that number that you found. For example, Yahoo bought Tumblr for $1.1 billion in 2013. Now, Tumblr was booking about $13 million in revenue that year and had approximately 300 million users. So we took that $1.1 billion divided by the $13 million in revenue to get that 84.6 number that you see, and then the $1.1 billion deal divided by 300 million active users for that 3.7 times multiple. So we find that transaction value multiple for each deal. Then you see that I've created some summary stats here below. Now, I like to list these out below for the average, median, the highest multiple, and then the lowest. Being able to see it here just gives you an idea of how close the deals are. You can see which are the highest, which are the lowest. Then you have to question why. Why was Microsoft willing to pay so much per sales for Yammer in 2012 than it did for LinkedIn in 2016? While you're asking these questions, you start thinking about how closely your new stock IPO compares to these deals. Is it pretty much like the average, or does it have a competitive advantage that might mean valuation should be at the high end? Generally, I'll use the median multiple here and apply that to the company that we're analyzing. Because there's quite a bit of variation here, I decided to go with the multiples in the LinkedIn deal though. Both LinkedIn and Pinterest are relatively well-developed platforms compared to some of these other targets. The LinkedIn deal was the latest, so it's probably a little bit more applicable to today's values as well. So if we take the multiples on that LinkedIn deal, this 9.5 times sales and the 60.5 times monthly users, then we multiply those with the estimates that we have from Pinterest for about 1.06 billion in 2019 revenue and about 291 million monthly users, we get this estimate for value from 11 billion to about 17.6 billion dollars. Now that's still a pretty big range, but I'll show you how to narrow it down after we walk through our second valuation method. But this is just going to start to give you a range for valuing that new stock. Now the second way we can value an IPO or a new stock is by comparing it to similar companies already trading on the market. This is called the public comparables or market approach. Now here you see the table, and this one is going to be slightly easier than the M&A approach. You first do that Google search for publicly traded companies plus the industry. So here it was pretty easy to get a list of 5 social media companies with shares available. Next, you can go to any investing platform or Yahoo Finance and find the rest of your information. You'll find the market cap for the company, which is the share price times all the shares outstanding. So the total market value here. You can look at the company's financial statements to find its revenue or sales for the last year. Here I had to do a search to find the current data for monthly active users on each platform. Now again, usually you'll be using sales and maybe EBITDA for those 2 columns, but I knew from my research that monthly active users was a better measure, so I decided to use it for the evaluation on Pinterest. So you do the same thing here as in that M&A model. You take your market cap of the company divided by the metrics that you found. For example, Facebook books roughly 56 billion in annual sales and has 2.38 billion monthly users. Taking this 524 billion market cap divided by each of these numbers gives me that 9.4 multiple and then the 220 times multiple you see here. So again, you can show the summary stats below, and it's kind of all over the place for these. Investors are paying about 9 times sales for established platforms like Facebook and Twitter, while Snap gets a little bit higher valuation and Yelp is just in the doghouse. The multiples on monthly active users are really revealing though. For platforms like Facebook and Twitter, which have their monetization down, they know how they're making money off users, investors are paying much more per active user. On the other hand, for platforms like Snap and Yelp, which haven't really figured out quite how well to make that money, investors aren't paying nearly as much per user. So here I decided to use the price multiples for Snap because I feel like it and Pinterest are still very close in their life cycle. Both have a high number of monthly users, but have struggled a little bit to find a way to monetize that base. Growth is stronger at Pinterest, though sales are a little higher on Snap. So when we use that 12.1 times sales multiple and the 53.1 times MAU on the data that we have for Pinterest, we get these 2 estimates for 12.8 billion and 15.45 billion. Now I know what you're saying. We've got 2 different valuation methods, each with 2 estimates on the value of Pinterest. Which is it? How do I know what is a good price for the stock? Now this is where you use a little bit of that market analysis on the company and put together what's called a blended valuation. So if you look at the 2 methods, you get a low estimate around 10.1 billion and a high around 17.6 billion. Taking the average of the 2, you get a low around 11.5 billion and a high around 16.5 billion, and an average centered right around 14 billion, which is where Pinterest is trading now, just under $26 a share. So we have an idea that the fair value for Pinterest is right around where the stock is trading. Now we look at the growth and the competitive positioning from our market analysis. Now growth in revenue and monthly users is stronger than a lot of the other social platforms. I also like the fact that Pinterest has elements of search in its function rather than just a social platform. I think it makes it much more monetizable and less susceptible to competition compared to pure social platforms like Twitter and Snapchat. I think the revenue growth is there. Like that comparison to Facebook, Pinterest just needs to prove its monetization plan. Now take all these together and you can make an argument that the shares should be worth the top end of those estimates rather than towards the bottom, and a good deal from here on out. Now, if you were doing this for a new stock waiting to IPO, it'd be no different. You'd just have your proposed IPO share price and the market cap for the company to use in your analysis. Go beyond one single stock to see how I put together our stock market challenge portfolio by clicking on the video here. Our dividend portfolio is beating the market with nearly a 20% return so far this year and more than 6% higher than the stock market. Don't forget to subscribe to get all the best videos in beating debt, making money, and making your money work for you.